Hi, it's Eric Nuttall, the Ninepoint Energy Strategies with this week's update. We've been dealing with a insane level of volatility. Obviously, there are massive uncertainties that the market is trying to grapple with. For energy, the biggest is very clearly the impact of retaliatory tariffs and retaliatory tariffs. The concern that that's going to have an impact on the slowdown on global GDP, which seems quite honestly like a reasonable concern at this point. The market has been doing its best to digest headlines and tweets and interviews, etc. We've seen estimates for global demand cut. One of our consultants, Energy Aspects, reduced their 2025 and 2026 demand forecasts by about 450,000 barrels per day for 2026. I think everyone's guessing at this point. We'll talk to what companies look like at current prices, what companies look like at lower prices, key observations from 2 days of meetings with companies. But as we reflect on the oil price, demand is very clearly the big unknown. The ratio that we read earlier this week that I think is important is that for every 0.1% contraction in global GDP represents about 100,000 barrels per day of demand loss. And so periods of global GDP contraction are very, very rare. With that said, this is a unique period in history as we kind of contemplate what is President Trump trying to achieve? Is this actually a big negotiating tactic to get a 10% baseline across the board? Is this truly a desire to reshore manufacturing in America? Time is going to tell. And so I don't think anybody can really, with confidence, forecast GDP growth for this year, next, and as a consequence, demand growth. And that's just an uncertainty we're going to have to deal with. Supply is a little easier to measure. The biggest source of short cycle supply, we've talked about this a lot, has been US shale. As we record this, oil is just a fraction below $60 WTI. And that really is the death zone for oil production growth. It's like, you're climbing Mount Everest and you get to a certain elevation, in this case, a certain price. And if you stay there, you die. That is where we are now. US shale companies, I think, are having active conversations in boardrooms all over Texas and North Dakota, for that matter. I would not be surprised to see a pretty sharp contraction in the rig count that will come out on Friday afternoon. We think the companies in this current environment, and we'll touch on this in a few minutes when we talk about the meetings that we've had with Canadian companies and a few US over the past few days, the priorities are always protect the business, protect the balance sheet, protect your dividend, and then protect buybacks. And so what is being cut now is any discretionary spending, any growth CapEx right now, I think is being cut across the board. Even though we've had a bit of a recovery from let's call the mid 50s to the high 50s, it's not a price where any shale company, especially with depleted inventory, is going to want to be drilling. So we think consensus coming into this year was for growth of about 200,000 to 300,000 barrels per day of black oil. On an exit-to-exit basis, so December to December, we think US shale falls by at least 500,000 barrels per day at the current oil price. And so that would represent a 0.5% demand hit from a contraction in global GDP. So again, 0.5% percentage drop in GDP, 500,000 barrels per day. And so there is this corrective mechanism, at least from balances. I'm the first to admit right now, we are in a market where I think there's nobody left to defend the oil price. Volatility is too high for oil traders to deploy capital on defending flat price and trying to take a stake, because the uncertainty and volatility is just too high. We also have the unknowns, the uncertainties of OPEC plus policies, the announcement that we had last week of the expedited return of barrels beginning in May. There have been stories about Kazakhstan pledging to improve compliance. The market is obviously very, very skeptical of that. And so we look to the May 5th meeting as the next mile marker for OPEC plus to try to gauge, okay, what is the new policy? We continue to believe that it has not been White House pressure being applied, but instead it's a desire to improve compliance from chronic cheaters. And an extension of that is to restore confidence in future deals, should they be necessary as well, because I think there is a lot of skepticism now. And I think there are some key actors within that voluntary deal that abided by it, and in fact, they over-complied and they've been penalized for it. And so that's our basis. But in the short term, what I think it means for the oil market is the elimination of the perceived OPEC put, some theoretical price level that the market thought that they would defend. And so at a time of massive, massive uncertainty on demand, the lag effect of short cycle supply, the belief, at least of the market, that we've lost the OPEC put, oil price is going to go where it's going to go. For the holdings that we have roughly 35, 40% in oil, 55% in natural gas right now, and about 5% cash. We met with our biggest holdings that would represent, we've got two 10%ers. They would both be mid-cap Canadian oil sand names. One of them is net cash, no debt, over 100 million on their balance sheet. Modest growth this year on a long cycle project. The other committing modest long cycle growth measured over the next couple of years. And you look at the sustainability of production, the strength of balance sheets, it's laughable because we draw these analogies between today and March, April 2020, when then you had an actual demand shock and uncertainty around OPEC policy when Saudi flooded the market on March 8th, 2020. And today we have the belief that we're going to get the potential demand shock married with uncertainty around OPEC plus policy. And so it's funny to contrast the nature of conversations that I was having back then versus now. The conversations then was, okay, what's your liquidity? What's your solvency? How many months of liquidity do you have? What's your banks, saying, your bank lines, etc. Today, it's all about, okay, where are you defended to? We estimate on average for Canada, oil companies need $51 WTI USD to both generate enough cash flow to maintain production, so flat production, and pay dividends, which today you can go out and buy names yielding 8 to 9.5%, what we think are sustainable dividend yields, down to $51 WTI. $51 WTI, we think US shale falls by over 1 million barrels per day. So that seems pretty draconian. We averaged $40 for 2020 when we had the biggest demand shock in history, when demand fell as much as 30 million barrels per day. Well, today demand's still growing. So it's not a fair comparison, but the conversations reinforced just how strong the average business model is of Canadian oil companies. They've spent the past 3 years deleveraging, so balance sheets are just in phenomenal shape. Many companies have no debt. Others down at 50 have like a turn to turn and a half of debt. And so balance sheets will allow Canadian companies to weather this storm that we're in far, far, far better than US shale. They'll be kind of like the last man standing, if I can use that analogy. We met with some other holdings, one other large one, they're a large Clearwater player, and it was kind of shocking even to us. We're going through our models with them. They thought without the benefit of hedges, they're sustainable down to $43 WTI. And so the panic that we're seeing in equities, it's understandable. But I was really comforted to go through with all of our key holdings and go through, okay, what does the balance sheet look like? What's your plans for growth, CapEx, and all these different things? The general messaging was very clearly discretionary spending on any growth from most companies is going to be evaluated, is actively being evaluated. I think rigs are going to get dropped. Unfortunately, I do think there will be layoffs. There's any discretionary expenses are being evaluated. But any fear of, okay, production declines and dividend getting cut, those were not in the realm of the conversation as of right now. So we were very comforted from that. So broadly speaking, what's our game plan? We look to take advantage of panic and fear and uncertainty. We do not think that the current price, so I'll say sub $60, is sustainable. A falling oil price is demand stimulative. The falling US dollar is demand stimulative. More importantly, what we can measure, because the demand impact is huge unknown right now, is really on supply. If we are in a market where you have to reduce US shale short cycle to balance the market, we think we're at that price to do that now. And I admit, the oil market typically will overshoot. We'll see where things go in the very short term. Picking an oil price is challenging. Let's run with the current oil price right now, so $60. We'd have the sector trading at about a 6 to 7% free cash flow yield. So it's fine. It's not overly compelling. But what it's allowing is the ability to take advantage and either add to or build positions in companies where, again, the value of long lead inventory will grow. We will get through this price storm. We wouldn't be surprised to see that we were expecting stock draws this year. So inventory levels remain near very low levels. We wouldn't be surprised to be kind of flattish if demand contraction does occur. And we remain optimistic, at least, that if you get improved compliance from some key members, that OPEC will reassert their role of providing stability to the oil market. So time will tell on that. In terms of natural gas, we remain bullish on the outlook for natural gas, believing that $5 is the marginal supply cost. That view is reinforced from a few meetings that we've had, both from Canadian companies and US companies, as was our view that US shale is in its twilight. We've talked about that before. Energy aspects, we subscribe to their short, medium, and long-term look. They just updated the long-term outlook, and it reinforced the loss of meaningful US shale, and that was confirmed in several of our meetings with key US shale companies today, where they're talking about, there is an inventory challenge, and it's just becoming more obvious. And as it becomes more obvious, I think it'll be less taboo for public companies to admit that in the public sphere. And the importance of that is we see a M&A wave coming to Canada, I would say over the next year, depending on the oil price, where US shale companies will be forced to replace their depleted inventory, both in terms of duration and quality. And in Canada, again, it's a key theme for us. Where we're invested is you can get multi-decades worth of stay flat inventory, i.e. free cash flow, for nothing right now, especially after the contraction we've had. And so that reinforces our belief that there will be a scarcity premium applied to Canadian oil companies. This was a little longer than our typical update. Market has been enormously volatile. We continue to look for opportunities amidst the carnage, with the admission that if the oil price is going to do what it's going to do over the short term, we're dealing with 4 to 5% intraday swings. But the strength of the business model, the average Canadian company, be it the quality of their acreage, their low decline rates, so less sustaining capital relative to the US peers, very strong balance sheets, sustainable dividends, it should give you comfort. If you know what you own, it gives you the staying power to weather and endure the volatility that we're seeing, not just in the energy sector, but in the broader market right now. And so thank you for your time, and we look forward to next week's update.